at the bottom of the page, number 5, to get there overnight. So this is a very incremental way, a reasonable way, one that we need the actuary to certify, which he has done, that we get to the 100%. And we really absolutely need to get to the 100% because we have to get there sometime. It's not negotiable. It's not, again, like we could get a list of where this is with the obligations of the county, and I think it's like 2 or 3 at the top of our list. Maybe our auditor knows where it stands, but if the county has no funds, this one is like one of the first things that you have to pay as you're heading to bankruptcy. So, you know, we're not getting out of it, we're not getting around it, and maybe someone could comment on that in terms of this is county money that's owed, and maybe Mr. Knudsen could give us just a little snapshot of the investment picture now and the forecast for the rest of the year.
Okay, yeah, I could touch on your first issue first of it being a debt to the county. I mean, a debt from the county to the retirement system. Both times we issued pension obligation bonds, we had to go to court and have what is called a validation. And the county basically sued itself. And in Superior Court, there was a decision came down that yes, this is a debt of the county to the retirement system. The reason that was done is we couldn't really fund the debt or sell bonds to cover that debt. We could refund. We're refunding that original debt that the county had between the retirement to the retirement system. So it is a legitimate debt. The last validation was done in 2002. We don't routinely do that. We would only do that if we were looking to issue pension obligation bonds, which are still a very good investment by the county. By the way, I don't have the information in front of me, but I think the average interest that we pay on our bonds is right at 5%, which is they're not government municipal bonds, which are non-taxable. They're fully taxable to the investor, and that's a very good return for bonds that are being sold to somebody who has to pay tax on them. The other issue, the first half of this year, we were doing very well. Our investments were increasing every single month. We're very diversified in our investments. We have 27 different, we use mutual funds because of our size, and in order to have investments in every different sector of the market, we have small cap growth, small cap value right on down the line. And we have international investments, and we have real estate, and we have bonds, and we spread these out over 27 different managers. And through the first 6 months, we were doing very well. In January, February, we were doing very poorly, just like everybody else who has any money in the market. I think January, I think we lost like $13 million on a $350, $60 million portfolio. February was a little less of a loss. It was about $3 million. The market's all over the place. Every day it's up and down. This morning when I left for work, it was up 280 points. The Dow Jones was up. We don't know where we stand now. We think we've probably given up just about everything in the first 2 months of 2008 that we gained during the last 6 months of 2007, but we have 4 months to go before we get to the end of the year. I think we'll have a positive return, but it's not going to be $50 million. I can tell you that right now, but I think it will be positive. But getting back to Supervisor's pensions question, as Harold covered when we first started out here, yes, we earned $26 million in 2007, more than we thought we were going to, but we're putting $21 million of that off to cover a year like 2007, 2008, where we could have a loss. And we're not going to suffer that loss all in 1 year. We're still going to have, let's see, the 2004 year will go away next year. It just drops off the page. But 2005, we'll cut that in half. We'll have about $8 million, $800,000, excuse me, from 2005 that we'll be able to use next year to smooth the losses that we may incur in this current year. And on to 2006, we'll have.
We'll come to $12 million that you'll recognize next year, this coming year, for previous gains that were not fully recognized at the time. And then the following year, just from these 4 years, you'll still have another $9 million you'll recognize to offset, to either improve your asset return or offset losses. So this whole process is to create a much smoother funding pattern than the volatility you'd otherwise expect this year.
And actually, if you went back far enough and looked at this 5-year smoothing, back when 2000, 2001, and 2002, when the tech bubble burst, we're all familiar with that, we had negatives in the far right column. And Jennifer said to mention this, it's kind of hard to grasp, but when you have a negative there and you have a loss for the year, you're spreading losses instead of spreading gains, and you really get the benefit of like a double negative in this process here, and you really benefit from losses, and you really suffer a little bit from gains because you're spreading those gains out over the future 5 years. In the other case, you're spreading losses over 5 years, and so there is a benefit to having a loss. We don't ever want to have a loss just for that purpose, but it does benefit your plan. And again, you can see the earnings above or below in the third column from the left: 15 million, 4 million, 8 million, 26 million. You never know what your gains and losses are going to be. That's why it's benefit to spread them out over many years, over a 5-year period, and enjoy that smooth. You pretty well know your contribution rates aren't going to increase or decrease in any given year by any large amount. You can count on what they're going to be. They're predictable.
If you look on page 4 of the report, there's a column called funded ratio. That's the ratio of assets to liabilities. And you can see that in the year ending June 30th, 03, after the bonds were issued, the funded ratio jumped up to 96%. And then with this smoothing technique, despite positive returns in the next couple of years, you were still amortizing the losses in 2001 and 2, and the ratio dropped in the next 2 years. So this smoothing technique mitigates those swings. These would have been much larger had we not adopted this technique.
Okay. So back to previous discussion, we should take up the next item and then come back to this item, County Council?
I think so. The amendment to the funding agreement,
Okay.
I believe.
All right. Is there any objection from the board to moving ahead with the next item and then coming back to this item for action? Okay. Let's move to that item then. Item 9B.
We're kind of figuring out who's to do what. We've covered a lot of that
Same
information
things.
already.
Yeah.
But
Okay, well, I'll just say something and then you can add anything you need. So what this amendment does is it revises and replaces section 3 of the funding agreement. And in your packet that was given to you today, you have the old funding agreement, and the only copy of it we could find signed, which we got from our consultants. Anyway, that's the old funding agreement. What the amendment does is it replaces section 3, and in essence, the old section 3 talks about a 90% target balance as you're funding your accrued actuarial liability in the retirement system. And the new section 3 talks about a target balance of 100% reached over a 10-year period. So it is, in essence, is setting up, to use the term, an amortization schedule for the debt to get us to 100%. And, you know, this needs to be looked at as another debt that's on the books of the county, that there is an expectation it be paid off. And the time frame for that is, in fact, 10 years. It's somewhat coincidental that we're talking about 1% increments each year, and over a 10-year period to get us to that 100%.
Supervisor Pinches.
What, has anybody looked into the option of refinancing our pension obligation bond at the interest rate we have and adding to fund it at 100% actuarial and do a new COP on that? Has anybody looked at the, I mean,
sure
would that
someone